Today we're going to talk about journalizing the flow of inventory. We've already done some learning in class. You can see down in the right hand corner, this is the pictorial representation we used, how inventory flows from when we buy it into raw materials, then into work in process, then into finished goods, and then eventually we sell it into cost of goods sold. But we need to understand, well, what accounts are involved, and we're going to look at the assets, so the different inventory accounts, raw materials, WIP, finished goods. Again, these are all assets, all inventory accounts as well, just different stages of inventory. We'll look at the equities, so the sales, the cost of goods sold, and the manufacturing overhead. Of course, your debits are your actual, your credits are your applied when we're talking overhead, and we'll get with that as we're going. Other accounts that would be involved, we'll see things fly off the screen, so payables, accounts receivable, that sort of thing. Doesn't really impact what we're looking at here, so we're just going to have those go away. Might as well. So let's look at some transactions so we can get the feel for the flow. First of all, we got $40,000 of raw materials. We buy them on account. So where are we going to put those? But our raw materials inventory. Debit the inventory account, make it go up. And bye-bye, that's probably some payable, maybe it's cash, but that's where the credit's going. So we've got $40,000 of materials inventory, but we got to do something with them. So we're going to transfer it into production, start working on it. So we'll credit our inventory, our raw materials, and debit our WIP. All we're doing is moving it from one inventory account to another. We're actually starting to work on it. So it's not a raw material anymore. It now has some sort of work being done to it. Along with those raw materials that we know about, we might have some indirect materials. Maybe it's glue or something of the nature that we don't necessarily measure, but we know, all right, this is a pretty good value for it. So we got to credit our raw materials another $4,000. And if it's an indirect material, that's going to be part of our actual manufacturing overhead. So there we go, put it over on the debit side of the manufacturing overhead account. Applying overhead is just your estimate. This is, I'm estimating it will cost me $12,000 worth of various work in order to produce this item. So the $12,000 we're going to debit to our work in process because that's where it impacts our inventory, is when we start to work on it. And then since it's an applied, that's when we credit manufacturing overhead. Right, during the year, we have to, during the course of the time of production, we have to spend $7,000 of direct labor. Again, that's working on the inventory, that's adding value to the inventory. So the inventory is continuing to go up there. And the other $7,000, well, we credit salaries payable or cash. I mean, we got to pay our employees. What about indirect labor? Well, indirect labor might not be fully on the piece of inventory, so we're not going to debit there. We're going to put that in our overhead. We're going to say, hey, this helped produce the item, but it didn't necessarily go onto the item. And again, it's paying the labor, so salaries payable or cash or something of the nature. Throughout production, we pay $5,000 for factory expenses, so that could be depreciation on the factory, that could be utilities on the factory, that could be using up insurance on the factory, but nonetheless, $5,000 for factory expenses. So the debit, again, we don't know where exactly it impacts the inventory, so we're just going to put it in manufacturing overhead. We figure it does somewhere along the line, though, so we'll put it in the overhead. And the credit, you know, whatever we did. If we paid for it, cash, but it doesn't impact these accounts. From there, say we've actually completed products with a total cost of $30,000. Now we go ahead and transfer it to our finished goods. So that's going to come out of WIP, and we're going to put it into finished goods. So we'll credit our WIP. We'll debit our finished goods. Again, we're just moving it from one inventory account to another. And then we actually finally make a sale. We sell a product costing $3,000 for $5,750. So the $3,000 is going to come out of our finished goods inventory. So credit your finished goods inventory and debit your cost of goods sold. Now we've actually sold a good. Now you got to remember there's also the $5,750 portion. So we go ahead and we credit our sales, and we would debit accounts receivable since we sold it on account. Last thing we have to do when we're thinking of our inventory, after we've gone through the whole flow of it, was, well, now we need to close our over or under applied manufacturing overhead. And we're going to go ahead and say the amount in this case is deemed immaterial. So we need to look over at our manufacturing overhead account, and we need to compare our debits and credits, because in the end, again, this was an estimate. These are the actuals, but we need to get it now to equal, because while we're working on the inventory, we need to value it, and we thought, well, $12,000 is a pretty good estimate, and it was, because in the end, we're only off by $500. We've got a credit balance of $500. So to close it, we need to debit the $500 in manufacturing overhead, and then we'll go ahead and just close it out to cost of goods sold. If the amount's deemed material, well, now we need to put it into finished goods inventory, WIP, and maybe in cost of goods sold, and allocate it on a ratable basis. But in this case, immaterial, let's go ahead and put it in cost of goods sold, and we'll say, you know what, that item really didn't cost us as much as we expected. So hopefully you've got the flow of inventory. If you have questions, please make sure you ask.